You have 72 hours. That's it. After that, the window closes and these prices are gone forever. I'm not being dramatic here. I'm looking at market data right now that suggests we're at an inflection point that happens maybe once every decade, and most people are going to miss it completely because they're waiting for confirmation that will never come. Let me show you exactly what's happening behind the scenes and why this weekend might be the last chance you get to position yourself before everything changes. Gold just broke through resistance levels that held for months. We're talking about technical barriers that traders have been watching like hawks, and they shattered in a matter of days. But here's what nobody's talking about in the mainstream financial media. This isn't just a technical breakout. This is the beginning of a fundamental repricing of precious metals that's been building for years, and it's all coming to a head right now. The smart money has been positioning for this quietly, methodically, while retail investors were distracted by tech stocks and crypto volatility, and now we're seeing the acceleration phase begin. Think about what's happened in just the past few weeks. Central banks around the world have been buying gold at a pace we haven't seen since the financial crisis. Not slowing down, not pausing, accelerating. The World Gold Council's data shows central bank purchases hitting levels that would have been unthinkable just a few years ago. These aren't amateur investors making emotional decisions. These are the most sophisticated financial institutions on the planet, run by people with access to economic data and geopolitical intelligence that you and I will never see. And they're loading up on physical gold like there's no tomorrow. But it gets more interesting. Look at what's happening in the COMEX warehouses. Registered gold inventory, the stuff that's actually available for delivery, has been draining at an alarming rate. We're talking about the physical metal that backs all those paper contracts, and it's disappearing. Every week, more gold leaves the warehouse than comes in. This creates a situation where the paper market and the physical market start to diverge. And when that divergence gets too wide, something has to give. History tells us it's always the paper market that breaks first. Now let me tell you about something that happened that most people completely missed. There was a day recently where the premium on physical gold over the spot price spiked to levels we normally only see during full-blown market panics. Dealers were charging significantly more than the quoted price just to get their hands on actual metal. That's not normal market behavior. That's a warning sign that the physical market is getting tight. When you can't get metal at the quoted price, that quote becomes meaningless. It's like looking at a menu price for a dish that's sold out. The number doesn't matter if you can't actually buy it. Quick thing before we go deeper. If you're watching this and you're thinking about how to protect your retirement savings from what's coming, I put together a free guide that breaks down the wealth protection strategies thousands of American retirees are using right now. It's in the description below. No cost, just information you need to make informed decisions. Grab it while you're thinking about it. Now silver. This is where things get really wild. Silver's been on an absolute tear, and the fundamentals behind this move are even stronger than gold. Why? Because silver is both a monetary metal and an industrial metal. It's caught in this perfect storm where investment demand is surging. At the same time, industrial demand is hitting record levels. Electric vehicles use significantly more silver than traditional cars. Solar panels are consuming silver at unprecedented rates. The green energy transition that governments around the world are pushing, it runs on silver. Literally, you can't build these technologies without it. But here's the problem. Silver mining hasn't kept pace with demand, not even close. Most silver comes as a byproduct of other mining operations, copper and zinc primarily. So when those base metal mines slow down or shut down, silver production drops, even though silver demand is screaming higher. We're looking at a structural deficit that's been building for years, and it's finally starting to show up in the price. The market is waking up to the fact that there simply isn't enough silver to meet all the demand that's coming. Let me paint you a picture of what happened during the last major silver squeeze. We're going back to when silver went from under $20 to nearly $50 in a matter of months. It wasn't a gradual climb, it was an explosion. And what triggered it? The same thing we're seeing now, a combination of investment demand meeting industrial demand while supply remained constrained. The difference this time is that the industrial demand side is even stronger because of all these new technologies that didn't exist back then. We're talking about a demand profile that's fundamentally different and more robust than anything we've seen in previous cycles. Think about the average American retiree right now. You've spent decades building up your nest egg. You've been responsible. You've saved. You've invested in what your financial advisor told you were safe, diversified portfolios. But what happens when the dollar loses purchasing power? What happens when the bonds in your portfolio are paying interest rates that don't even keep up with real inflation? You're not actually preserving wealth. You're watching it erode in slow motion. And the scary part is that most people don't realize it's happening until it's too late to do anything about it. The Federal Reserve is in an impossible position. They've got inflation that's still running hot despite all their rate hikes. But they also have an economy that's showing serious signs of stress. Commercial real estate is imploding. Regional banks are sitting on massive unrealized losses in their bond portfolios. The government is running deficits that would have been considered catastrophic just a generation ago. So what do? They're trapped. If they keep rates high, they risk breaking something major in the financial system. If they cut rates, they risk reigniting inflation. Either way, hard assets win. Either way, precious metals become more attractive. Here's something that should terrify anyone paying attention. The debt to GDP ratio in the United States has crossed levels that historically have led to currency crises in other countries. Now, I know what you're thinking. America is different. We have the world's reserve currency. We can print dollars, and the world has to accept them. That's been true for decades, but is it still true? Look at what's happening with the BRICS nations. They're actively working to create alternative payment systems that bypass the dollar. They're settling trade in their own currencies. They're accumulating gold specifically to back these new arrangements. This isn't conspiracy theory stuff. This is official policy that they're announcing publicly. When the Saudis start accepting yuan for oil sales, that's not just a business decision. That's a geopolitical earthquake. The petrodollar system has been the foundation of American financial dominance since the 1970s. If that system starts to crack, if oil can be purchased in currencies other than dollars, then the demand for dollars drops. And when demand for dollars drops while supply keeps increasing through money printing, basic economics tells you exactly what happens to the value of each individual dollar. It goes down. And when the dollar goes down, gold and silver go up. It's not complicated. Let me tell you about a conversation I had with a bullion dealer recently. This is someone who's been in the business for over 30 years, seen multiple boom and bust cycles, knows this market inside and out. He told me something that stuck with me. He said the current market feels different from anything he's experienced before. In previous bull markets, it was mostly retail investors driving demand, regular people buying coins and small bars. This time, it's institutions. It's family offices. It's ultra-high net worth individuals moving serious money into physical metal. These are people who have access to every investment opportunity in the world, and they're choosing to allocate significant portions of their wealth to gold and silver. That tells you something. The technical picture on the charts is screaming continuation. We've got gold breaking out of a multi-month consolidation pattern with strong volume. That's not a false breakout. That's real buying pressure. The moving averages are all aligned bullishly. The momentum indicators are showing strength without being overbought. This is the kind of setup that technical traders dream about. But more importantly, it's confirming what the fundamentals are already telling us. The market is repricing these metals higher, and we're still in the early stages of that repricing. Silver's chart is even more explosive. We're looking at a pattern that suggests significantly higher prices ahead if this breakout holds. And given the fundamental backdrop we just discussed, there's every reason to believe it will hold. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been compressing. That's historically what happens when silver is about to outperform gold. And when silver outperforms gold in a precious metals bull market, the moves can be absolutely spectacular. We're talking about percentage gains that dwarf what gold does. Now, I need to address something important here. If you're sitting on retirement accounts worth $100,000 or more, you need to understand something that most financial advisors won't tell you. There are ways to get physical precious metals into your retirement account without triggering taxes or penalties. It's called a gold IRA, and it's a strategy that's been around for decades, but most people have never heard of. I put together a comprehensive guide on exactly how this works, what the rules are, what the benefits are, and what the potential pitfalls are. It's in the description. If you've got significant retirement savings and you're concerned about the things we're discussing in this video, market instability, currency debasement, geopolitical chaos. This is worth looking into. It's not for everyone, but for people in the right situation, it can be a powerful wealth protection tool. Check it out if it's relevant to your situation. Back to what's happening in the markets right now. The COMEX, which is the major exchange where gold and silver futures are traded, is showing some really interesting dynamics. Open interest has been climbing, which means more contracts are being created. But at the same time, the amount of physical metal available for delivery has been falling. This creates a mathematical problem. If even a small percentage of those contract holders decide they want physical delivery instead of just cash settlement, there isn't enough metal to go around. And when that realization hits the market, prices can gap higher violently. We've seen this movie before. It doesn't end well for the people who are short physical metal. Think about the mining companies for a second. These are the businesses that actually pull gold and silver out of the ground. Their costs have been rising significantly. Energy costs, labor costs, equipment costs, regulatory costs, everything is more expensive. But the price of the metals they're producing hasn't kept pace with those cost increases until recently. That means many mining operations have been running on thin margins or even losing money. What happens when an industry becomes unprofitable? Production gets cut, mines get shut down, exploration budgets get slashed, and that sets up the next supply shortage down the road. We're planting the seeds right now for a supply crisis that will hit in a few years, and the market is starting to price that in. The jewelry demand story is fascinating too. In countries like India and China, gold jewelry isn't just decoration, it's a store of wealth. It's how families preserve purchasing power across generations. And as the middle class in these countries continues to grow, their demand for gold grows with it. We're talking about billions of people who have a cultural affinity for gold that goes back thousands of years. They're not going to stop buying because some Western economist says gold is a barbarous relic. They understand something that modern financial theory has forgotten. Gold is money. It always has been. It always will be. Let's talk about what happens in a real crisis scenario. Not fear-mongering, just looking at historical precedent. When the financial system comes under serious stress, what do people reach for? In every major crisis, whether it's a currency collapse, a banking panic, a war, whatever, people flee to precious metals. It's happened so many times throughout history that it's basically a law of human nature at this point. Gold and silver become the ultimate safe haven because they're no one else's liability. A bar of gold doesn't depend on any government's promise. It doesn't depend on any corporation's solvency. It just is. And in times of uncertainty, that certainty becomes incredibly valuable. The derivatives market for precious metals is absolutely massive. We're talking about notional values that dwarf the actual physical market by orders of magnitude. Most of these derivatives are used for hedging and speculation, and they work fine in normal market conditions. But what happens when market conditions aren't normal? What happens when there's a rush for physical metal and the paper market can't deliver? The whole structure becomes unstable. And the people who are holding paper promises instead of physical metal find out the hard way that there's a big difference between the two. This is why serious investors, the ones who really understand these markets, insist on physical possession. They don't want to be holding someone else's IOU when things get chaotic. Here's a question you should be asking yourself. Why are central banks buying gold if it's just a useless relic with no real value? These institutions employ some of the smartest economists and financial analysts in the world. They have access to data and modeling capabilities that are light years beyond what any individual investor has. And they're choosing to convert their currency reserves into gold. Not stocks, not bonds, not real estate. Gold. They're doing this for a reason. They see something coming that makes physical gold more attractive than paper assets. And if the central banks are positioning for something, maybe we should be paying attention. The supply chain issues that we saw during the pandemic exposed how fragile our just-in-time global economy really is. When things break down, when transportation gets disrupted, when production facilities shut down, suddenly the things we took for granted become scarce. And precious metals are no exception. During the height of the pandemic, there were times when you literally couldn't buy physical gold or silver at any price. The mints were shut down. The refineries were closed. The dealers had empty shelves. but the paper price kept trading like nothing was wrong. That disconnect showed everyone who was paying attention that the paper market and the physical market are not the same thing. And when push comes to shove, it's the physical market that matters. Let me tell you what's happening with the big institutional players right now. Hedge funds are taking massive long positions in precious metals futures. These aren't small speculative bets. These are serious allocations by funds that manage billions of dollars. They're looking at the same data we're looking at, and they're reaching the same conclusions. The risk-reward setup in precious metals right now is extremely favorable. The downside is limited because there's so much fundamental support under these markets. But the upside is potentially enormous if we're entering a new bull market phase. That's the kind of asymmetric opportunity that sophisticated investors live for. The ETF flows tell an interesting story too. We're seeing consistent inflows into gold and silver ETFs, which means investors are adding exposure to these metals through their brokerage accounts. But here's the thing about ETFs. When you own shares in a gold ETF, you don't actually own gold. You own shares in a fund that owns gold. There's counterparty risk there. There's management risk. There's the risk that in a real crisis, you might not be able to convert those shares into physical metal. That's why the really smart money is buying physical and taking delivery. They want the actual metal in their possession, not a claim on metal that someone else is holding. Think about the geopolitical situation for a minute. We've got tensions rising in multiple regions around the world. We've got great power competition heating up. We've got supply chains that are being weaponized. We've got sanctions and counter-sanctions. We've got the potential for conflicts that could disrupt global trade. In this environment, countries want to hold assets that can't be frozen or seized by foreign governments. And what asset fits that description perfectly? Gold. Physical gold held in your own vaults can't be sanctioned. It can't be cut off by SWIFT. It can't be confiscated by executive order from another country. That's why we're seeing this massive repatriation of gold, with countries bringing their gold reserves home from foreign storage. The inflation story is far from over, despite what the official numbers might say. Anyone who actually buys groceries or pays rent or fills up their gas tank knows that prices are still significantly higher than they were a few years ago. And they're not coming back down. Once prices rise, they tend to stay elevated. That's the ratchet effect of inflation. Your dollars buy less, and they're going to continue buying less as more dollars get created. The money supply has expanded dramatically, and that expansion isn't being reversed. All those dollars are out there in the system, chasing a relatively fixed amount of goods and services. Economics 101 tells you what happens next. Prices go up. And when prices go up, hard assets that can't be printed become more valuable. Let's talk about the weekend effect. Why does this weekend matter so much? Because markets are closed. Because the big players can't react immediately. Because by the time trading opens again, the landscape might have shifted. If there's a major geopolitical event over the weekend, if there's a policy announcement, if there's a crisis that develops, the first trades on Monday morning could gap significantly higher. And if you're not positioned before that happens, you miss the move. You end up chasing prices higher instead of getting in at current levels. This is why timing matters. This is why waiting for perfect confirmation is often a mistake. By the time everyone agrees that precious metals are going higher, they've already gone higher. I want you to think about your personal situation for a moment. How much of your wealth is denominated in dollars? How much is in assets that depend on the continued stability of the financial system? How much is in things that could be frozen, seized, or devalued by decisions made by people you'll never meet? And how much is in hard assets that you control, that can't be printed, that have held value for thousands of years? For most people, the answer to that last question is zero or close to it. Their entire net worth is tied up in the system. And if the system has problems, they have problems. Diversification isn't just about owning different stocks. Real diversification means owning different types of assets, including assets that exist outside the traditional financial system. The mining stocks are starting to wake up too. These are the companies that produce gold and silver, and their stocks tend to be leveraged plays on the metal prices. When gold goes up 10%, mining stocks might go up 20 or 30%. But they also come with company-specific risks: management risk, operational risk, political risk if they're mining in unstable countries. That's why many investors prefer to own the physical metal directly. You get the exposure to rising prices without the additional risks that come with owning shares in a company. The metal doesn't have a CEO who can make bad decisions. It doesn't have a balance sheet that can deteriorate. It just sits there, holding its value, waiting for the world to recognize that value. Here's something that doesn't get talked about enough: the psychological aspect of owning physical precious metals. There's something deeply reassuring about holding real money in your hands, not paper promises, not digital entries in a database. Actual physical metal that has been recognized as valuable by every civilization in human history. In times of uncertainty, that psychological comfort has real value. It helps you make better decisions because you're not panicking. You're not watching your portfolio evaporate in a market crash and feeling helpless. You've got a foundation of real assets that you know will retain value no matter what happens to paper markets. The technical analysts are all pointing to the same thing right now: breakout, continuation, higher prices ahead. The chart patterns are textbook bullish. The volume is confirming the moves. The momentum is building. This is what the beginning of a major trend looks like. And the beautiful thing about trends is that once they get established, they tend to persist. Markets don't move in straight lines, but they do move in trends. And right now, the trend in precious metals is clearly up. Fighting that trend, waiting for a pullback that might not come, trying to time the perfect entry, these are all ways to miss the opportunity. Let me bring this back to the urgency of the situation. We're not talking about a theoretical opportunity that might develop sometime in the future. We're talking about something that's happening right now. The prices you see today might be significantly lower than the prices you see next week. The availability you have today might not be there tomorrow. The premiums dealers are charging today might spike higher if demand surges. This is a time-sensitive situation, and the clock is ticking. You have this weekend to make a decision. After that, the market opens again, and whatever is going to happen will start happening. Think about how you'll feel if you watch precious metals surge higher over the next few months and you're not positioned. Think about the regret of knowing you saw this coming. You understood the fundamentals, you recognized the opportunity, but you didn't act. Versus how you'll feel if you take action now and you're holding assets that are appreciating while everything else is uncertain. That's the choice in front of you, and it's a choice you need to make soon. The smart money has already made their decision. The central banks have made their decision. The institutional investors have made their decision. They're accumulating precious metals because they understand what's coming. The only question is whether you're going to join them or whether you're going to wait until it's obvious to everyone, at which point the easy gains will already be gone. The best opportunities in investing come when you see something before the crowd does, when you act on information and analysis while others are still skeptical. That's how wealth gets built, not by following the herd, but by being ahead of it. I want to leave you with this thought. Throughout human history, gold and silver have survived every empire, every currency, every financial system. They've outlasted kingdoms and governments and central banks. They've held value through wars and depressions and hyperinflations. They're the ultimate long-term store of wealth. And right now, at this moment in history, they're telling us something. They're telling us that the current system is under stress, that the paper currencies we use every day are losing purchasing power, that the financial engineering and money printing and debt accumulation are reaching levels that can't be sustained forever. And when the system resets, when the dust settles, gold and silver will still be there, still holding value, still serving as real money. You've got until this weekend ends. That's your window. After that, we're into a new week, new market conditions, new price levels. The opportunity that exists right now might not exist then. So here's what you need to do. If you're serious about protecting your wealth, if you understand what we've discussed in this video, if you recognize that we're at a critical juncture, take action. Don't overthink it. Don't wait for perfect conditions. Don't try to time the absolute bottom. Just get positioned. And for those of you who made it this far, who watched this entire video, I've got something special for you. That free guide I mentioned earlier, the one in the description, if you download it and you're an American retiree with at least $100,000 in retirement accounts, you qualify for a complimentary one-on-one educational web conference. No obligation, no sales pressure. Just a detailed walkthrough of how precious metals can fit into your retirement strategy, customized to your specific situation. This is only available to people who mention they watched this video all the way through. It's my way of rewarding the people who are serious about this, who take the time to really understand what's happening. Grab that guide, mention this video, and let's have that conversation. The clock is ticking. The market doesn't wait for anyone, and the prices you see right now are not guaranteed to be here tomorrow. Make your decision, take action, protect your wealth while you still can, because after this weekend, everything might look very different. And you'll either be positioned for what's coming, or you'll be watching from the sidelines wishing you had acted when you had the chance.